Episode 4.
This is day 2 of learning how to fucking trade. So,
Today we're going to be going over liquidity, which is essentially the foundation of ICT concept. So we hinted a little bit at this with the previous video on market structure. We showed you how the bodies and the wicks tell two very different stories, and we're going to elaborate on this today with liquidity.
So the market moves in two ways. It moves to seek liquidity, and it also moves to rebalance the range. And we'll talk about rebalancing the range in the next video, but for this video, we're going to be talking about liquidity. So liquidity is essentially fuel for the next move. So the market makers, the big money, when they need to fill their orders, they need to grab this cash that is resting in the market to then move price in the way that they want to. And where is this cash that is lying, you may ask? Well, it's going to be resting in swing highs and swing lows. This candle formation is a 3-candle pattern. So a swing high is a lower high, a high, and then another lower high. And then a swing low is a higher low, a low, and then a higher low. I also see a lot of beginner traders getting messed up thinking that the actual color of the candle matters when we are creating a swing high and we are creating a swing low. For example here, when we have 2 green candles and then 1 red candle, these colors don't matter, right? This can be a red candle, this can be a red candle, like bearish, bullish. These candles here, these can be 2 green candles, this can be a red candle. The colors do not matter. What you should be focusing on is the lows and the highs that are created to make these swing lows and to make the swing highs. Okay, so what does buy-side liquidity and sell-side liquidity actually mean? We have to understand first the psychology of traders. Let's say you want to take a short position, right? You're betting that the market is going to move down in this scenario. Where are 90% of traders putting their stop losses? Well, you're most likely going to put it at that recent swing high, right? So this is referred to as buy-side liquidity. If you are in a short position, you put your stop loss at this high. So you have sold contracts here, and then you need to buy them back to actually get out of that position. So there is a lot of cash that is resting here. So what is big money going to do to enter into the market? Well, they're going to take all that cash, and then they're going to move towards the direction they want it to go. Versus here, when you have swing lows resting here, if you are in a long position, where are 90% of traders putting their stop losses? Well, they're going to be putting it at that low, at that swing low. So what's resting here is sell stops, right? You have sell side liquidity here, because if you're in a buy position, you then need to sell those orders to get out. And this is just a huge pool of liquidity and a huge pool of cash for the market makers and for big money to then step in and take this to then move higher.
So these newly initiated swing highs and lows are going to serve as stop losses for retail traders, which is going to act as a magnet for price to trade back into, grab that liquidity before the real move is actually initiated. And the reason liquidity and this lesson in general is so important is because it's going to help you understand how to avoid being liquidity, how to avoid being stopped out unnecessarily. Alright guys, think about it this way. You want to go buy some drip, but you got no money on it. But your homie, he's always leaving cash at his crib, just laying around, $100 bills on his nightstand. So what do? Obviously, you can't go buy clothes if you got no money. So you hit a lick on this kid, take all that cash grab, liquidity sweep, and then you go buy all the drip. There's cash that's resting, and it needs to be taken if you want to get dripped up. Okay guys, so start getting in the habit of marking out those obvious swing highs and swing lows, which is going to serve as sell-side liquidity and buy-side liquidity. If you're looking at the charts, you can clearly see that here we have sell-side liquidity, and then at this swing high, we have buy-side liquidity. So as you can see here, we make our new swing low. This is going to serve as our sell-side liquidity, and then we deliver higher. We take out this buy-side liquidity, and we create our new buy-side liquidity, right? This is our new swing high. Then what happens? We deliver lower and we create a swing low. Here we generate a new level of sell-side liquidity. This is going to be our new swing low. And then price delivers higher and starts delivering lower. This becomes our new buy-side level. This is going to be our buy-side liquidity. Price delivers lower and creates this new swing low. This is our new sell-side liquidity. And then we create another swing high, which is going to be our new buy-side liquidity once again. So as you can see now, right, there's a sequence of buy-side and sell-side being generated. We have this sell-side, we have this buy-side. We create a new swing low, sell-side, new swing high, buy-side, new swing low, sell-side, new swing high, buy-side, new swing low, sell-side, new swing high, buy-side. And then this move runs through all of this liquidity, comes down all the way back to this first level, and now this becomes our new sell side liquidity. Finally, you can see that price runs through all this liquidity and takes out all these buy side levels, and this is our new swing low, and this is our new swing high right here.
So from this range, guys, just mark out the most obvious swing highs and swing lows that you see. The most obvious in this scenario is going to be this high here and then this low here. This is sell side liquidity here. This is buy side liquidity here.
These liquidity levels should be sticking out like a sore thumb, guys, right? They should be easy to spot, and the more you practice spotting these liquidity pools, the easier it's gonna get. Also, when you're starting out, like Blake said, focus on these major liquidity pools, right? You don't wanna just mark out every single high and low you see and then cram up your charts with unnecessary information. This is gonna end up putting you into analysis paralysis, and you're gonna get more confused than you have to be. Keep your charts clean, guys.
Alright, so we're now going to be talking about liquidity sweeps and what that actually means. I'm sure you guys have heard this term used a lot by a lot of smart money concepts traders and ICT traders. What this refers to is when big money and the market makers are grabbing sell stops or grabbing these buy stops that we have marked out to then move the market in their direction. So we have to think about it in this way. 90% of retail traders fail in the market. What do 90% of retail traders trade? So they either trade support and resistance, so they trade very objectively in the sense that, okay, they see this move getting made, right? We have a really big uptrend here, so they think, well, if we come down and retest this low, we should do the same exact move since, we just had that move. So this is called support. So they'll see this as a big support level. And so they'll see this big support level and they'll go long here thinking that this same move is going to happen and will push up higher. And where will they put their stop losses? Well, at that low. So they think about trading in a really objective way, and you end up seeing that these stop losses end up getting ran before price actually wants to make its move. Now, there's also another way that retail traders often trade, and this is using breakouts. So what this breakout looks like is they'll think, okay, if we break below this low, then we should continue trading lower. And they'll put a short position here. And where are their buy stops going to be rested? Well, at that swing high that we had, right? This is our buy side liquidity level. And then they will get stopped out of their position, and smart money and market makers end up winning in the end.
So to really simplify that whole analysis, just understand that when one person is getting out of the market, another person is getting put into the market.
Because not only are people looking to get long here off that support level and then getting stopped out, what this liquidity sweep is essentially doing is also putting people in orders. So they're also filling orders and getting people into short positions and generating even more liquidity at these buy side levels. And this is why I love ICT concepts so much, because there's always this narrative behind every single trade that I'm taking, right? I'm not just marking out random support levels and random resistance levels. Like, there's a reasoning for every single trade that I'm taking. And this is, I think, absolutely necessary when you're first learning to actually understand how the market is truly moving.
The thing with ICT concepts is that you'll actually understand why you're taking a win or why you're taking a loss every single time. You'll understand why price is going to the next target. As you get better at understanding liquidity, you'll get better at determining the overall narrative of price. This is why liquidity is so essential to ICT concepts, because it is how the market moves. Right, guys? The market moves in two ways: to either seek liquidity or rebalance ranges. We'll get into the whole ranges thing in the next video, but eventually you'll see after this whole series that everything ties together and plays off of each other one way or another. And that's why ICT is so effective, because not only does it make sense technically, but it makes sense logically as well. And if you feel lost right now, don't worry. We're gonna keep showing you some more examples to help you get the understanding of it. We'll even give you some homework at the end so you can look over shit on your own and just get better at analyzing this whole thing. But right, the general consensus is that swing highs are gonna serve as buy side liquidity, swing lows are gonna serve as sell side liquidity. The reason we're teaching you how to identify this liquidity is because if you can learn to identify where that liquidity lies, then you'll also be able to identify when it is taken and when it is the right time to enter a trade. But for now, just focus on learning how to identify liquidity.
Alright guys, so looking at this chart, take a few minutes here, pause the video, and mark out your significant swing highs that you see and your significant swing lows. So this is going to be your major buy side levels and your major sell side levels that you're seeing right now on this chart. And we're going to give you guys some background music while you're doing this.
Swing high, swing low, liquidity, take it and we go. Swing high, swing low, liquidity, we take it and we go. Got buy side and sell side. Got buy side and sell side. Alright, so here we have your major buy side liquidity and then your major sell side liquidity. So look at what has been taken, and then also we have sell side liquidity resting here in the form of swing low, sell side liquidity here, sell side liquidity resting here, and also sell side liquidity resting here. We also then have buy side liquidity resting here, and then this buy side liquidity to the left of us has been taken. So this buy side level here, here, and here.
And if you're wondering why it has been quote unquote taken, it's because price already traded above these levels, meaning therefore that liquidity has been taken. And these three buy side levels that haven't been taken is going to be the liquidity that is still valid and where stop losses are going to be placed. So once again, here you have your two major liquidity levels, your buy side up here and your sell side right here. And then you have the sell side liquidity right here and this buy side liquidity right here. This has already been taken. So watch as I play out price now, and it targets this buy side liquidity up here, which is going to be holding a bunch of buy stops, right? For anyone who's in a short. Anyone who's in a short is stopped out right here because this is where all the stop losses are resting for shorts. And then we go ahead and trade towards that sell side liquidity. Bang.
And after all of these sell stops are ran and these retail traders are taken out of the market, and once the market makers have grabbed all of that cash and grabbed all of that liquidity, they then move price towards the direction that they want it to, and they target this buy side liquidity here and also these swing highs that are put into the market here.
So guys, as we wrap up this video on liquidity, I decided to show you a 4-part illustration which summarizes exactly what we had taught you. So if you look all the way on the left here, the first thing that happens is a swing high is created. That swing high becomes a buy side liquidity, right? If people are going to be shorting their market, where are the buy stops going to be sitting? At the swing high, at this buy side liquidity. Remember, those are interchangeable words. Buy side liquidity, swing high. Then what happens? This buy side liquidity is traded away from. People are shorting and their buy stops are resting right here. Why is it called buy stops? Because they're shorting the market, and so if they get stopped out, in the case where you're trading futures, your contracts are being bought back. Then, third step. In the process of buy side liquidity being traded away from, sell side liquidity is created. And after the sell side liquidity is created, price goes ahead and takes out the buy side liquidity. So now we are stopping out all the people who were shorting the market, where buy stops are resting at this swing high. And finally, price trades now to the next liquidity, which is going to be, that sell side liquidity we had created, or any other liquidity that is resting further down in the market. So break it down into 4 parts, guys. First, identify where these swing highs and swing lows are created. Once you find that, notice how price will typically trade away from this level, which ends up resulting in a manipulation move for 90% of retail traders. Then that level is traded back into, those retail traders are stopped out, and then the real move is initiated. The whole reason that ICT concepts is so important and that liquidity is so important is because it, 1, serves as a foundation, but 2, is going to help you avoid being liquidity, right? You need to understand liquidity to avoid ending up as liquidity. That being said, this practically concludes our ICT for Dummies, episode 4, liquidity. We teach you how to make money. Identify the swing highs, then liquidity gets taken.
Place trades with simple order management tools. Access over 40 built-in indicators plus custom indicators. Get real-time updates, latest market news, and insights. Get started at ninjatrader.com.
Welcome to ICT for Dummies, episode 5. Well, we just did 4. We just read. You're so fucking retarded. You're so retarded. You're so retarded. It's episode 5, guys. Okay. 1, 2 for value gas. This is where price attracts. Yeah. 1, 2 for value gas. For value gas. Taps in, usually reacts. Doesn't matter if green or red. Green or red, homie.
black and white.
We'll have like charts that are also like
Black and white, and we don't discriminate.
alright. So
So for this video, we're gonna be going over fair value gaps. What exactly is a fair value gap though? So a fair value gap is basically just an imbalance in price. So when price has huge movements in the market, we leave behind imbalances. Imbalances are from an inefficiency of orders getting filled. So what price tends to do is trade back into these inefficiencies and use them as areas of support or areas of resistance. So there's two different types of fair value gaps. We first have here a sell side imbalance. This is a bearish fair value gap, also known as a SIBI, a sell side imbalance. And what a fair value gap essentially is when the low of the first candle's wick doesn't overlap with the high of the third candle's wick.
or in a bullish sense, the high of the first candle's wick doesn't overlap with the low of the third candle's wick. Here we have it broken down into really 5 main components that make up a fair value gap. So it is a 3 candle sequence. In order to create a fair value gap, you need at least 3 candles. Candles 1 and 3's wicks do not meet, which obviously you can see right in front of you. It is an imbalance in price. It acts as a magnet and delivers price in corresponding direction.
So a sell side imbalance, what this really means is the market is trying to tell you that it wants to go lower. A sell side imbalance shows displacement towards lower prices, right? This is a very fast move where orders aren't filled. Okay guys, so what a fair value gap is trying to tell you is that it wants to either go for lower prices or it wants to go for higher prices. So a bearish fair value gap is showing displacement. It's the market telling you that it wants to seek lower prices. And what a bullish fair value gap is trying to tell you is that it wants to seek higher prices. To get this sell side imbalance, you can expect it to target things like sell side liquidity. And what a bullish fair value gap is showing is bullish displacement in the market. It is telling you that price wants to seek higher prices. And this could be, for example, buy side liquidity.
So if you got super freaking confused with what Blake was saying before with efficiencies and shit and nothing really made sense in your head, all you need to know is that there's an imbalance in price that needs to be corrected, right?
So as you can see here, if we drag out the low of this wick, you can see that it doesn't overlap with the high of this candle's wick, creating this imbalance. There is a gap between the low and the high, meaning that is a bearish fair value gap. And if we do the same thing over here, the high of this first candle's wick doesn't overlap with the low of this candle's wick right here, meaning that it is a fair value gap. So as you can see here, this is not a fair value gap. Why? Because the low overlaps with this candle's high. And as you can see, there's a wick that overlaps, meaning that there's no imbalance in price. And this is not what a fair value gap looks like. And then as you can see here, this is also not an example of a fair value gap because this candle wick's high overlaps with this candle wick's low. So this is not an example of a fair value gap. You need spacing between the wicks.
So I decided to make you a compilation. So here on the right, we have essentially from the beginning of a fair value gap formation to when price actually trades into it and reacts, right? Because what does price do? Price first creates the imbalance, price trades into it, and then it reacts. So as you can see here, we have the formation, right? You have candles 1, 2, and 3. Here we're talking about in a bullish sense. What happens is you have that separated wicks between candles 1 and 3. You can see that the high of candle 1 and the low of candle 3, both of these wicks do not meet. And you can see that right here, right? Unlike this, where they're overlapping, right here, they are not overlapping. Third, you have the actual imbalance / fair value gap. So once you can identify that these wicks are not meeting, you can mark out this actual imbalance / fair value gap. Price will typically trade into these levels, which you can see illustrated here with the red candle trading into this fair value gap. And then you can see the price reacts, right? So if we're trading into a bullish fair value gap, what are we expecting? We're expecting a bullish reaction and for price to continue trading higher. So let's say you're looking at a bullish chart, right? All bullish price action is going to contain some sort of retracements. When price retraces, it's typically to fill an imbalance. It's typically going to hit a fair value gap, right? So in order for price to continue higher, it needs to trade back towards these imbalances, and then it will continue delivering higher.
And why price is doing this is again to fill orders. There's going to be an imbalance of orders. And once price retraces into this imbalance, that is where orders get filled.
The same goes for in a bearish sense, right? If you are looking at a bearish chart with bearish price action, you're going to notice that as price is delivering lower, it is still retracing, correcting these imbalances, filling these orders, and then it continues to deliver lower. If you're looking at a bearish chart, this is what you're most likely going to see. You're going to see price is going to trade lower, hit these fair value gaps, and then continue trading lower, right? Price trades up, hits fair value gap, continues lower. Price trades up, hits these bearish fair value gaps, continues trading lower, right? And this happens over and over and over, and it will continue to push price lower. The same is going to apply in a bullish sense. If you're looking at bullish price action, you're going to notice that price will deliver higher, retrace into these bullish fair value gaps, and then continue higher, right? You'll see this all the time. Now let's show you the difference between what a fair value gap and not a fair value gap looks like in real time. All right, so now we're gonna play through price and show you what fair value gaps actually look like on the chart. So I want you guys to know also that there doesn't actually have to be a wick. As you can see here, this body does not overlap with this candle's high here, and this is still a fair value gap. You can imagine there being a wick here, and as you can see, these wicks do not overlap, making this a bearish fair value gap. Another bearish fair value gap right here. And as you can see here, this is not a bearish fair value gap. Why? Because this wick overlaps with this candle's wick right here. So this is not a bearish fair value gap. Then trade into this bearish fair value gap. And as you can see here, we then created a bullish fair value gap. Why? Because candle 1's wick does not overlap with candle 3's wick. As you can see, this is a bullish fair value gap, or a BISI, a buy side imbalance, because candle 1's wick does not overlap with candle 3's wick, right? The high of candle 1's wick does not overlap with the low of candle 3's wick, making this a bullish fair value gap. And as you can see here, there's no fair value gaps getting made because all of these wicks are overlapping. And now for the most commonly asked question, does the size of a fair value gap matter? Well, to answer your question, yo.
Introducing Iron Beam, the best choice for futures trading. Iron Beam is the industry-leading broker catering to traders worldwide. With the free Iron Beam platform and free real-time data, you can trade the most popular futures contracts anywhere.
no, it doesn't, guys. It's all about the motion of the ocean, right? Any fair value gap can deliver price where it needs to. So just know that. Never determine a fair value gap's value by the size. Wow. But by its personality. Yes. And now as you can see here, we have this bearish fair value gap. All right, little quiz time, guys. Is this a fair value gap? Okay, the answer is no! This is not a bullish fair value gap, guys. Why? Because the wicks overlap. No imbalance here, guys, making this not a fair value gap. If you said no, you are correct. If you said yes, we got a little bit more studying to do, all right? Now, question number 2, guys. Is this a fair value gap? Yes, you are wrong. You got a little. I'm just kidding, guys. If you answered right, good job. I mean, really, congrats. The answer is you are wrong. You got a little. I'm just kidding, guys. If you answered right, good job. I mean, really, congrats, because this is a beautiful example of a bullish fair value gap. As you can see here, the candle 1's high of this wick does not overlap with the candle 3's low of this wick. And luckily for you, if you can identify the gap within a 3-candle pattern, there's a very high chance that you're not. Okay, guys, so with fair value gaps, you'll often hear terms like respected or disrespected, or a fair value gap has held, or a fair value gap has been inverse. So what does that actually mean? For a fair value gap to get respected, the body cannot close below the fair value gap. And this is in terms of a bullish sense, of course. Yeah. So as you can see here, we trade into this bullish fair value gap. The candle has respected this fair value gap. Why? Because the body has not closed below it. And you guys need to be waiting for the candle to actually close on whatever time frame you're looking at. You'll see candles trade all the way down here, and then the candle will actually wick and it will not close below the fair value gap. And this is still valid. This is still getting respected. So please know, even if we have a wick that goes all the way down here, it doesn't matter as long as the body has held. And you guys will often hear the term that wicks do the damage and bodies tell the story, which is why you have to wait for this candle to close to see if it's actually getting respected or not, or disrespected. And what disrespected means is that the candle has closed below this bullish fair value gap, and in a bearish fair value gap, the candle is closed above. So just to reiterate what Blake was saying, right? Let's look at candle 1's high. Candle 1's high, this wick right here, once this candle closes below it, or a candle closes below that wick's high, then the fair value gap is considered invalidated or inversed, right? Clearly here on the right side, you can see that price closed below this wick's high, disrespecting the fair value gap. And remember, guys, when a bullish fair value gap gets respected, what can you expect? Bullish price action to continue, right? And if a bullish fair value gap gets disrespected, then you can expect bearish price action to continue, and for this to then sell off. And I'd say fair value gaps is considerably one of the most important concepts to understand within the whole realm of ICE. DT, because you can really tell where price wants to draw towards, where price wants to go next by seeing if it is respecting or disrespecting fair value gaps, right? So if price is disrespecting bearish fair value gaps, what can you anticipate? That price will run higher. If price is disrespecting bullish fair value gaps, can you anticipate that it will run lower? In other words, if price is respecting bullish fair value gaps, it'll run higher. If price is respecting bearish fair value gaps, it'll run lower. The same applies for a bearish sense, guys.
The best applies for a bearish sense, guys. A respected and get disrespected. The same applies for a bearish sense, guys.
So if you look over on the left, you can see the price 3 candle sequence.
3 candles.
Candle 1 low, candle 3 high do not meet. Therefore, you create fair value gap. What happens? Price trades into fair value gap and it reacts, and therefore the wick respect, the body respect, the fair value gap is respected. On the right, you have this
Respected.
Why? Because the candle closes above candle 1's low, and therefore fair value gap is inverse, right? So price can trade all the way up here, but if it come back down and if we all the way down, it doesn't matter. It is still respected the fair value
Where
gap.
did that we go? Holy shit. Holy shit.
It's at all-time highs. Alright guys, we're gonna have a fucking breakdancing competition real quick, baby. No, lock in, bro. That wasn't funny. And just to give you guys a little bit more context on how to utilize fair value gaps. So as you guys know, price is fractal. And if you don't know what I'm saying, is that everything we are teaching you applies across all time frames, and it is happening all the time, whether it is on the 1 minute or the 1 hour chart. So just to put into perspective, if you go into the hourly time frame, the 4 hour, the 1 hour, or if you go into the daily, this is going to be your higher time frame. And inside the higher time frame, if you see that higher time frame fair value gaps are being respected, for example, like hourly bullish fair value gaps, or like 4 hour bullish fair value gaps, or like daily, that's going to help you with determining your bias, right? Determining that higher time frame draw on liquidity. But fair value gaps within like the 1 and 15 minute, that's more so going to help you with internal liquidity. It's going to help you determine where price is going to want to go to on the lower time frame, right? So
An award-winning trading app that is as easy to set up as your favorite playlist. Voted most popular broker 2022 by TradingView Awards. Open an account at www.owanda.com. Leverage trading is high risk. Losses can exceed deposits.
really, to simplify this, if you see prices respecting bullish or gaps in the higher time frame, you can expect it to trade towards something like previous day highs or previous week highs. Those are some buy side levels. If you see price respecting bullish or value gaps on the 1 minute chart, or the 5 minute chart, the 15 minute chart, you can expect price to trade to those buy side liquidity levels on the lower time frame. I'm saying this is because you don't want to base your entire analysis or your entry off like an hourly fair value gap and think that's enough confluence for you to be taking a trade, right? You want to analyze things across all time frames. So if you see that price is respecting bullish fair value gaps on the hourly, and then you go into the lower time frame and it's also respecting bullish fair value gaps on the lower time frame, well, you put 2 and 2 together, and now you can anticipate the price wants to run higher and figure out your targets from there. And so as we mentioned before, fair value gaps are imbalances in price. There are times where price can create these imbalances without it being exactly a fair value gap, right? Like you can see here, if I play out price action, you'll notice that the candles opened just far higher than they were trading previously here. And this typically happens when a new day of price opens up, and we call this a new day opening gap, right? Similar to a fair value gap, this imbalance is going to attract price. Price will typically react to it, but specifically with new day opening gaps, the one thing to note is that price will typically fill it completely, right, before actually making the corresponding move. With like a regular bullish fair value gap, you don't need to fill the fair value gap all the way for price to continue trading higher. You can simply tap into it and buy a couple ticks, maybe fill it halfway, maybe a third of the way, and it'll continue trading higher in a bullish sense. But with a new day opening gap, you want to see price fill it completely before you can anticipate that price will start trading higher. So if you play out price action, you can see that that's exactly what happens.
This occurs on Mondays. For the start of the week, you will see a new week opening gap, most likely, not all the time, but it sometimes happens on Mondays. And a new day opening gap is just any other day of the week, so just not Monday. This happens at 6 p.m. That is the opening of a new day. Okay, guys, so looking at this chart right here, I want you to identify a bullish fair value gap, and then I also want you to identify buy-side liquidity. Let's see if you remember from that liquidity video that we did last.
We'll give you 5 seconds.
5 seconds.
5, 4, 3, 2, 1, 0. Bang! There you go. So as you can see, you have that 3 candle sequence in the bottom. The wicks of candle 1 and candle 3 do not meet, therefore creating that fair value gap, creating that imbalance, and you have that buy side level above. So what does this mean, right? We create a bullish fair value gap and we have a buy side level above. We have some buy side liquidity. What do we expect? We expect price to trade into this fair value gap and then deliver us towards the buy side liquidity, right? The fair value gaps are helping you understand the story of price, helping you understand what the narrative is. So if you play price action forward, you can see price taps into that bullish fair value gap, and what happens? It goes ahead. So now with price action played out, what do we notice? We see that price trades into this fair value gap. It does tap it a couple times, but what does it do? It delivers us towards this buy side liquidity up here. All right, guys, and then here I want you to identify a bearish fair value gap, and then I also want you to identify some sell side liquidity here. 5 seconds. Okay, so if you answered this is your bearish fair value gap, you are correct. This is not a bearish fair value gap. Why? Because these wicks overlap. You can see that there is a lot of displacement and a lot of candles towards this liquidity. And we have liquidity where? Resting in this swing low here. We have more liquidity resting at this swing low. And all of these swing lows are your sell side liquidity. This is an imbalance. Price is going to trade back up to fill these orders. And this is where a lot of sell orders are getting placed. Price trades up, taps into this bearish fair value gap, and then price delivers towards all of this sell side liquidity. Now, if we look at price action right here, right before that sell off, what do we notice? We notice that price has been respecting bullish fair value gaps this entire time and delivering price higher. We have this very obvious bullish fair value gap right here, which you can clearly see has been respected multiple times, and price continues to deliver higher. But what do we notice? Eventually, price displaces through. We get a body closure below this fair value gap. What does that mean, guys? It's been invalidated. It's been inversed, right? This bullish fair value gap has now been disrespected, and we can now anticipate that price wants to run lower. And as you can see, price continues lower. All right, guys, now watch this. Price is creating bullish fair value gaps, respecting bullish fair value gaps, continuing to trade higher. This bullish fair value gap gets disrespected. We create the 3 candle sequence. 1, 2, 3. We have the bullish fair value gap right here. Price trades lower, invalidates this bullish fair value gap. It is now disrespected, and now price goes lower after disrespecting the bullish fair value gap. And how did we identify that? We have our 3 candle sequence right here. Candle 1, candle 2, candle 3. What do we notice? Wicks of candle 1 are not intersecting with the wick of candle 3. Therefore, we create this imbalance, this fair value gap, this buy side imbalance. And now if I play the next candle, you can see that this candle displaces lower, closes below candle 1's wick. In other words, the body closes below this fair value gap, disrespecting the fair value gap and inversing it. When this happens, you can anticipate that price will continue lower. So as you can see, this candle closes below that bullish fair value gap. After this bullish fair value gap gets inversed, we trade into this one. Right after, we inverse the next bullish fair value gap. We can see that we get a body closure below that bullish fair value gap. So therefore, it is disrespected. We wait again. We can also see that this candle disrespects this bullish fair value gap through a body closure below. Therefore, it is also inversed. All three of these bullish fair value gaps have been disrespected, and now we can anticipate that price will continue running lower. And as you can see, it runs all the way down here. What do we notice here? We see that after delivering lower, price opens up a bearish fair value gap. We have that 3 candle sequence. You have candles 1, 2, and 3. What do we notice? We notice that candle 1's wick does not overlap with candle 3's wick. Therefore, we create a fair value gap. Immediately after, price displaces higher, disrespects this bearish fair value gap, also meaning it got inversed. We also start trading into this bearish fair value gap, and then
100 plus cryptos, countless stocks and ETFs, and options. eToro
eventually price inverses this one as well. Both
Hold on, buddy. You're right.
These fair value gaps get disrespected, and what happens now? Price continues running higher. So hopefully that helped you understand a little bit more about how price reacts to fair value.